Hello, everybody. Welcome to another episode of our Facebook Live. Today, I have Tom, my buddy and partner, where we do multiple deals, and we are also involved in many other deals, especially with industrial and storage. So, today, we are going to be talking about something which we got a few DMs. What is a REIT? REIT. And how does it differentiate from syndication? And how does it differentiate from a joint venture? So, again, Tom is here with us, and I will pass the mic off to Tom. And Tom, man, you go ahead and take it off.
Hello, everybody. Excited for another episode of our Facebook Live. And today we've got an exciting topic. We are going to talk about what is a REIT and what is a syndication, what is a joint venture. A lot of people have been asking about these three things, especially REITs, because in the stock market, you can go and buy a REIT or something that is related to real estate. A REIT is nothing but real estate investment trust. So we're going to talk about these things today. We're going to lay it out clear for you so you can decide which one you want to invest in. We come to you every week live here, educating you. And Dr. Noah Liu and myself, we founded this group, and we all our job, all what we want to do is educate you guys, and if you're interested, you can do deals with us too. But our primary goal is to educate you so you can be the decision maker here.
Oh, 100%. A lot of this information, we can always find it out on Google, or we can go to different places and sources. But what we like to do is we like to break it down for our new members. So this way, then they can understand how we understand our things, right? So let's talk about REITs. Let's dive a little bit into it. REITs are basically like paper, right, Tom? I
Yeah.
mean, it's not, you're not owning a physical location. You're not owning a physical real estate. It's mainly a piece of stock, like a stock exchange, like you get. So let's dive a little bit into it, Tom. When we talk about REITs, are they publicly traded? Is it like non-public? Is it like private? How does it work, or is it like all over the place?
Yeah, that's a great question. So the reason a lot of people even ask about REITs is because a lot of people are familiar with stocks, and when you go to the stock market to invest in something, especially these past couple of weeks, has been really volatile. Like people have lost 10%, 15%,
Hmm.
25% in some cases just in 3 weeks, right? But
That's crazy.
yeah, and when it comes to REITs, and then that's when they start looking at other options where they can get some fixed income. When they put the money, not only does the stock go up a little bit, but they also get fixed income, and that's where REITs come into play. REITs are nothing but real estate investments. When what other companies do, these
Right.
companies who own real estate properties could be like a large institutional player who owns, for example, a bunch of medical office spaces. They rent it out to people, and then they get monthly cash flow from that, and they take a portion of that and they distribute it to you guys, or whoever invests in that REIT. And that's what a real estate investment trust means. And really, you're not owning any real estate, you're just
Hmm.
owning a portion of the business, basically. But the business just invests in real estate, and you get a monthly cash flow. The stock is not going to appreciate like the other stocks, but you get
Right.
dividends every month.
And it's basically like you're owning like part of the shares, right? So the shares of that portfolio. Different kind of REITs are, you can actually invest in the equity portion. So let's
Hmm.
say if someone is raising capital, they want to invest in the equity portion. They're like, okay, cool. We're going to put like a 25 or 30% down. That's where some of those REITs can be generated from. And
Hmm.
primarily their cash flow is coming, just like real estate is coming from rent,
Mm.
right?
Yep.
And just like other real estate investments, we can also have REITs invest in debt, right?
Mm.
Or they can also be called as mortgage REITs. Basically, it's just taking the mortgage out of that balance that's owed to the bank, and they are actually buying it from the bank. So all it is just a different form of investment. The best part about REIT is it's liquid, and it's kind of like adjusted for the market, but it's liquid. The downside is it's like anything else in the stock market, like Tom just said. I mean, it can go up, or it could go down. And then the other type of REIT is hybrid, where people as investors, where we can invest in both mortgage as well as equity. So that's a little bit about REIT. And some of the other cons, Tom, we just spoke about this before we got on, right? What are some of the tax advantage and disadvantage with REITs?
So the tax benefits, basically your income is going to be taxed as your regular income when whatever you get from in REITs. You're not going to get the tax advantages of
Mm,
owning real estate like depreciation and things like that. There's no way you can claim that if you own REIT, because you're really not owning any real estate yourself. You're not an owner in the asset. You're
correct.
owning a portion of the business, a small percentage of the business that owns the asset, and you have no rights to the asset, and therefore you cannot claim depreciation, which is one of the major advantages of owning real estate, and that is not there when it comes to REIT. But like Dr. Noah Lu said, it is liquid. Anytime you want money, you can cash it out and take the money immediately.
AKA stocks.
Yeah,
Right.
right.
The only attractive thing is kind of risk adjusted. But I don't know, when the market goes down, Tom, everything goes down, right?
Yeah. This goes down, but it may not go down as much because it
Correct.
never went up that much in the first place. It
It's
just
got a
goes.
low growth, basically.
Yeah, it's a very slow growth, but you get monthly cash flow if the property is making money and if they're done running a good operation. But there is also some things you should watch out for. There's many REITs that it's very management heavy. The management takes a lot of salary fees and all that, and finally you really get low distributions. So there are some REITs that you got to watch out for. They just make all these claims. When it comes to distributions,
Hmm.
because of all the fees that's involved, you get some months you may get, some months you may get very low, some months you may get pretty good. So that's something you got to watch out for when you go in for
And they
REITs.
have really, really high management fees and
Yeah.
and all that stuff. All right, so let's dive into the next one, which is syndications. This is another one where people are like, hey, if I can invest in REITs, why syndication? And if I can do syndication, why REITs? So vice versa. Um, syndications. Syndication is again nothing more than, we are running a business, right? We have a group of investors or group of partners that they actually go out there. They will go ahead and find the deal. They will underwrite the deal, and they will actually put their own names on the mortgage on that deal. And then they'll have limited partners who will actually come on in as investors, as capital investors, and they will pour in money into that deal. So, Tom, you want to give a little bit about the split and how all that works, where we call them GP, LP? What's all those terminologies and what's their function?
Yeah. So syndication is basically a process where multiple investors pool their money and they come together. And like Noel was saying, the GPs, there are some people who take the risk of finding the deal, putting their name on the mortgage, signing their name on the debt, all kinds of things. But and then they want to raise money to buy the asset, and they go out
Hmm.
and find limited partners or investors who have. They don't have to worry about signing on the debt. They don't have to worry about managing the property. They don't have to worry about getting the mortgage, all that kind of stuff. It's taken care of by a bunch of people called as general partners,
Correct.
and they just ask people to come together as investors. They're called as limited partners, and then the limited partners enjoy all the returns and the risks and whatever is involved in the asset along with the general partners, and the general partners take a small percentage, probably usually about 20%, sometimes 25. About 0 to 30% is the norm, and they get paid because of that small percentage. So that's a general partner, and who runs the show, takes care of asset management, property management, all that stuff. And the limited partners enjoy the cash flow, and they
Hmm.
get to enjoy the tax advantages because they actually own a piece of that
That's
property.
huge. That's huge. And not only own the piece of property, they also get the depreciation,
Mm-hmm.
right?
Yeah.
In the property, when the property, we do the depreciation study, and they also can participate in that as limited partners. So advantages and disadvantages. GP and LP, general partner and limited partners. So limited partners, like Tom said, are divided into, like, a higher portion for the profit, because they're the one who actually are the capital investors, and then the general partners are the smaller profit shareholders, because they are the limited in terms of capital.
Mm-hmm.
However, general partners are the guys who actually are the main driving force of the deal. So when we invest in a syndication, we always want to look at the general partners. We want to look at the track record. And like Tom always says, bet on the jockey. And that's where these guys need to come in with liquidity and with experience.
Mm-hmm.
I mean, so many times we've said it again and again, like, invest in someone that you know and who are reliable and who have the experience and track record. Many times we see all these ads that come up like, oh, invest in this, invest in that. But what happens is we don't even know those guys,
Mm-hmm.
right?
Mm-hmm.
So, uh, general partners are the guys who actually go out there, do all this good stuff, and the limited partners come in and pour the capital and get a return on it. The downside about being a limited partner is there is no control. That's the downside of being a limited partner. And the downside of GP is if something goes wrong, whatever happens, it's their line and their name on the credit line. All right. And then the last thing that we want to touch base on is JV partner, which I'm kind of getting a little bit more favoritism with JV here a little bit. So JV is joint venture. Joint venture is basically just a pool of investors, a pool of guys coming in, investing in a property. Everybody has equal say, equal share, depending on how much money they're bringing in.
Mm.
Right? Do you want to add anything to
Absolutely.
that? I mean, it's pretty straightforward.
It's very straightforward, like you were
Right.
saying. It's just like, let's say you a couple of buddies come together and say, "Hey,
Hmm.
man, let's go buy this house, let's rent it out, let's make some money," and we both are equal partners, in everything. So that's what joint venture is. It's very easy on paper. It's just like buying a company and having two partners or three partners or 10
Right.
partners, and it's an operating agreement. There is
Hmm.
not much paperwork compared to syndication. So yeah, that's what JV is. It's just like two friends starting a business, buying a property, things like that.
Exactly, exactly. An entity is formed, everybody's on that entity, everybody's partner, and everybody gets the same distribution like anybody else. Um, the
So
only thing is,
here's so maybe a lot of people are asking now. Now you're explaining all these things, right? So which one I should go with? Here's what I would say is, if you're super busy, you don't want all the benefits of real estate, and you only care about monthly cash flow and you don't care about appreciation at all, and you love the stock aspect and the liquidity
Mhm.
aspects, then you might as well do a REIT. But
Yes.
my argument against that would be, if you're just going to invest in a REIT, in the stock market, find some of the stocks that pays you dividends. You don't need to invest in a real estate trust for that.
Okay.
Yeah, there's so many other stocks that give you dividends like 4%. Even Apple gives you, but it's only like 2% or something. But there are stocks like AT&T, I think, gives 5%. Verizon gives you like 6%, and the stock goes up as well. So why do you want to invest in a REIT really, if when there are other options and other great companies out there, right? And the REITs are run by mostly a lot of the small term guys, which are not very um, uh, I mean, they're not as famous as AT&T and T and Verizon and all that, although there are some REITs run by BlackRock and everything. But for the most part, a lot of the REITs are run by not very large corporations. So there's a little bit of a risk there. So that's the thing about REITs. So now, should I do a syndication or JV? Is what you may be thinking if you're
Mhm.
thinking about doing a deal. So the easy answer is, if it's a pretty small deal, and if there's not that many partners going to be involved, just do a JV. And if there's going to be a lot of partners involved and it's a pretty I mean, deal in terms of the dollar value. If it's a high amount, go the syndication route. Do you think that's right? No.
Absolutely. Absolutely. JV is so easy that anybody can do it. It's
Mm.
basically just joining up and getting it done. And it's not regulated by the SEC,
Yeah.
right?
Hmm.
Syndication and REITs, they are heavily regulated. So we kind of have to know, like, what kind of syndication. And again, that's a whole different chapter and a whole different story. But just to keep it simple, right? REIT, it's like buying stocks, going in there, having a portfolio. You can also diversify between REITs and stocks. And syndication is kind of like owning a piece of land, like being a small owner of that small percentage of that property.
Hmm.
And JV is kind of similar depending on how much you're putting in, but without all the hassle and paperwork. So something along like, for a newbie, differentiation, I'll call it 101, something how we understand things. And I just wanted to kind of make it simple and easy for everybody here. So Tom, anything else you want to add, man?
Oh no, that's it. I mean, we are looking at a couple of industrial deals with great cash flow, and if anybody's interested in partnering with us, definitely message Noel or myself. And
Absolutely.
and if you have any questions about this topic, actually, I know a lot of people would have questions about this. Just put it in the comments, and we'd be happy to answer them.
100%. And some of you might be wondering, like, how come we're switching from Thursday to Friday to Saturday? Well, hey, guys, like anybody else, I have a main business that I run, right? You all know that how it is at nighttime with patients. It kind of gets hectic. Sometimes we can't get it, sometimes we can't get to it. So, even though we love real estate, we still want to make it happen. We fluctuate different days. But like I said, Tom and I, we always believe if we have a profession, our main thing should be our main thing first before
Right.
we start indulging into other side items, right?
Absolutely, man. Totally. That should be your main thing. Focus on your main thing. Make
Hmm.
as much money as you can in the main business and invest it into real estate.
100%. All right, ladies and gentlemen, with that being said, enjoy the weekend. Happy Saturday, and we will see you guys next week.
All right, guys.
All
Have a
right.
good one.